This wasn't a sell-off. This was an execution. In a single trading session, something inside the global financial system snapped, and silver was the first bone you heard crack. Not slowly, not rationally, instantly, violently. The kind of move that doesn't happen when investors change their minds, but when institutions lose control. If you're staring at red numbers right now, feeling that cold pressure in your chest, understand this. You're not watching a normal market. You are watching a forced liquidation, a margin call so large it dragged gold, silver, and credibility down with it. Because here's the detail no headline will tell you. Markets don't crash like this because of fear. They crash because of desperation. Somewhere behind closed doors, someone didn't meet a call. And when that happens, value stops mattering. Only cash matters. Silver didn't fall because it's weak. It fell because it's liquid. That distinction will decide who survives what comes next. When gold and silver collapse together, when the so-called safe havens are dumped at the same time, that is the financial equivalent of smoke pouring out from under a locked door. You're not supposed to see that. It means something inside is on fire. And this fire spreads fast. Funds don't sell what they hate in moments like this. They sell what they can. Stocks are frozen. Bonds are choking. Private assets are trapped. But silver? Silver trades instantly, globally, relentlessly. So it gets sacrificed first. This is the dirty secret of modern finance. In a liquidity crisis, the best asset becomes the first victim. And today, silver was that victim. What you're witnessing isn't about supply and demand. It isn't about solar panels or batteries or industry slowing down. Those stories come later, after the damage is done. Right now, this is about leverage collapsing under its own weight, about margin requirements exploding overnight, about algorithms flipping from buyer to executioner in seconds, about a system that only functions when confidence is infinite and breaks the moment confidence blinks. This is how real crashes begin, quietly, mechanically, without emotion. And by the time the public realizes what's happening, the sell button has already been smashed. In this expose, we're going to dissect exactly who was forced to sell, why silver was chosen as the exit door, and what this margin call reveals about the next phase of the global financial crisis. Because this wasn't the end of the story, it was the opening signal. And what comes next will decide whether this was a temporary smash or the opening shot of something much bigger. The most dangerous moments in markets don't look dangerous at first. They look fast. This crash didn't unfold over weeks. Didn't give warnings. It detonated in hours. And that speed tells us everything. Because slow declines are emotional. Fast collapses are mechanical. Somewhere, massive leverage position cracked. Not a retail trader. Not a YouTube speculator. This was institutional. The kind of position that uses bonds as collateral. Swaps layered on swaps. Leverage stacked on leverage. When one leg failed, the entire structure tilted. And then the call came. Add cash. Now. This is where the story turns brutal. In theory, a fund-facing margin call can choose what to sell. In reality, choice disappears instantly. You can't sell what no one is buying. You can't sell what's illiquid. You can't sell what's locked up for months. You sell what trades right now. Gold, silver. That's why both were hit together. Not because they're weak, because they're trusted and liquid. This is the paradox that destroys unprepared investors. The stronger the asset, the faster it gets sold in a crisis. And silver is smaller than gold. Liquidity vacuum hits. Doesn't bend, it snaps. Every billion dumped into gold ripples silver like a shockwave. Same algorithms, same paired trades, same forced execution. This is how an 8% day happens without warning. Not panic selling, not fear. Margin cascade. One fund sells to meet a call. That selling drops prices. Those lower prices trigger margin calls on other funds. They sell too. The cycle feeds itself. Price doesn't fall because sellers believe it should. Sellers believe it should because sellers have no alternative. This is also why retail doesn't cause crashes. Retail hesitates. Retail argues. Institutions don't hope. Institutions don't hope, and the machines make it worse. Modern markets are run by algorithms trained to react, not think. When key levels break, they don't ask why. From long to flat, flat to short, within minutes. So what began as forced selling becomes amplified destruction. Selling triggers. Liquidity evaporates. The bid disappears. And suddenly, the price on your screen no longer represents value. It represents urgency. This is the moment where headlines lag reality. Where analysts scramble for explanations. Where social media screams manipulation. But the truth is colder than that. This is the system doing exactly what it was designed to do. Protect lenders, sacrifice assets, erase leverage. Silver didn't lose a battle today. It was thrown into one. And the most important question isn't why it fell. The real question is this. Who was forced to sell first? And who hasn't sold yet? Because that answer tells us whether this was the shock or just the opening tremor. There's one signal that separates a normal sell-off from a systemic event. It's not silver, it's not stocks, it's gold. Gold is not a trade, gold is collateral. When gold falls hard, fast, it means something far more serious than risk off. It means the highest quality collateral in the system is being liquidated, and that only happens when everything else has already failed. Gold is the piggy bank you smash last. So when gold drops hundreds of dollars in hours, the message is chilling. Someone ran out of options. Banks don't sell gold casually. Sovereigns don't dump gold impulsively. Pension funds don't panic sell gold. Gold moves like that only when balance sheets are under threat. This is why macro traders aren't staring at silver today. They're staring at gold. Because gold doesn't lie. It tells you when stress has gone global. And today, that stress screamed. Here's the hidden chain reaction almost no one talks about: the bond market. When bonds fall and yields spike, the value of collateral across the financial system collapses. Banks lend against bonds. Derivatives are built on them. Entire balance sheets lean on their stability. When bonds wobble, the calls begin. Post more collateral. Top up the margin. Wire cash by close. And if the borrower doesn't have cash, they sell gold. The gold sale hits the market. Algorithms detect it. Paired trades fire. Silver gets dragged down, not because of silver, but because gold just blinked. This is contagion. Silver isn't being punished for its fundamentals. It's being punished for being attached to the wrong partner during a crisis. And that's what makes this moment so dangerous and so revealing. Because the problem isn't isolated. It isn't a single fund. It isn't a bad trade. It's leverage layered across markets that all depend on the same fragile collateral base. When that base cracks, everything shakes. This is why the move felt illogical. Why explanations feel inadequate. Why the selling felt relentless. The system wasn't repricing silver. It was hunting cash. And when the hunt begins, nothing is sacred. But here's the twist most people miss. Liquidity crises don't destroy assets. They misprice them. They create moments where price disconnects from reality, where paper markets break away from physical truth. And silver, because it's both an industrial metal and a monetary asset, sits right at the fault line, which means what looks like collapse on a screen may actually be stress revealing itself. But before we talk about recovery, we need to talk about something even more dangerous than falling prices: the dollar. Because when fear spikes, the dollar doesn't rise politely. It swings like a wrecking ball. And what it does next could decide whether this crash ends quickly or spirals. When markets panic, they don't run to safety. They run to cash. And in this system, cash means one thing: the US dollar. This is the cruel irony at the heart of every liquidity crisis. The very currency that fuels leverage, bubbles and distortions, becomes the temporary refuge when everything starts to break. Fear doesn't buy assets. Fear hoards dollars. As institutions scramble to meet margin calls, they sell anything not down. Foreign currencies, commodities, crypto, metals. All of it exchanged for one thing: dollars immediately. This creates a violent surge in the dollar index. And since silver is priced in dollars, a rising dollar doesn't pressure silver, it crushes it. Think of it like gravity increasing suddenly. The metal didn't change. The unit measuring it did. This is why crashes feel unfair. You can be right on fundamentals and still lose on mechanics. The mechanics are running the show right now. Here's where it gets deadly for the unprepared. Leverage. When silver drops 8% in a single day, the leveraged account doesn't lose 8%. It gets obliterated. Brokers don't wait. They don't negotiate. They liquidate at the worst possible price to protect themselves. The bottom isn't formed by logic. It's formed by forced selling. And this is how people get wiped out while being right. They weren't wrong about silver. They were wrong about timing and structure. This is why today matters. This wasn't just a price move, it was a cleansing. Accounts that couldn't survive volatility are gone. Stops were triggered, positions were erased. And when that happens, something important changes. The market gets lighter. Weak hands disappear. Leverage unwinds. The selling pressure eventually exhausts itself. But not before psychology breaks. This is the phase where fear replaces greed overnight. Where yesterday's euphoria turns into tonight's regret. Where people stare at the screen asking, should I sell now before it gets worse? That question is the sound of capitulation forming. And capitulation is how bottoms begin. But here's the danger. In a liquidity crisis, the bottom can go lower than anyone expects. Price doesn't stop when it's cheap. It stops when forced sellers are finished. Which brings us to the most important distinction in this entire story. Paper silver versus physical silver. Because while screens are bleeding red, something very different may be happening in the real market, the one that actually uses metal. And if those two markets start to diverge, that's when the story takes a turn most people aren't ready for. Paper silver and physical silver are supposed to track each other. Most of the time, they do, until they don't. Paper silver is a promise, a contract, a line of code saying someone will deliver metal later. Physical silver is different. It has weight. It has transport costs. It has storage limits. And most importantly, it has supply constraints. During liquidity crises, paper markets move first because they're easy to sell. One click, one algorithm, one forced liquidation. Physical markets move last. And that delay is where cracks begin to show. Here's what usually happens next. Quietly off screen. While futures prices collapse, physical buyers step in. Not hedge funds, not traders, manufacturers, refiners, long-term holders. The people who actually need silver. They don't buy because it's exciting. They buy because it's suddenly cheap relative to reality. Premiums stop falling, and they stabilize. Then sometimes they rise. This is the moment most investors never see. The screen says silver is crashing, but dealers stop discounting. Delivery times stretch, inventory thins. That divergence is a warning sign. It means price discovery is breaking. Paper markets are still in liquidation mode. Physical markets are already absorbing supply. And when that gap widens, one of two things must happen. Paper prices rebound violently, or physical availability tightens dramatically. History shows which one usually wins, because paper silver can be created instantly. Physical silver cannot. This is why every major metals crisis follows the same psychological trap. People sell near the bottom because the screen tells them to. Meanwhile, the real buyers are quietly accumulating. By the time headlines turn bullish again, the move is already over. But here's the most important point of all, and this is where the story gets bigger than silver. This event wasn't about silver. Silver was a symptom. The real disease is leverage tied to unstable collateral, and a system that depends on constant liquidity. That problem doesn't get fixed in a day. Even if silver bounces tomorrow, even if gold recovers next week, the structure that caused the shock is still there. Which means volatility isn't leaving. It's arriving. The era of slow, predictable markets is ending. The era of sudden air pockets, flash moves, and forced liquidations is beginning. In that world, the biggest advantage isn't prediction. It's positioning. Knowing the difference between assets you trade and assets you hold, between paper exposure and real ownership. Because the next shot won't announce itself either. It will just appear on a screen. Fast, brutal, and unforgiving. And the only people who survive it calmly are the ones who understood this moment before the next one arrives. After every liquidity shock, markets enter the most deceptive phase of all, the calm. Volatility drops, prices stabilize, headlines move on, and people assume the danger has passed. This is where mistakes get made, because liquidity crises don't end cleanly. They echo. Here's the sequence history keeps repeating, almost mechanically. Phase one, the bounce. After forcing exhaust itself, prices snap back, not because the system is healthy, because sellers are gone. This bounce feels convincing. Commentators declare the bottom. Dip buyers celebrate. Confidence starts to return. But this move is fragile. Why? Because nothing structural has been fixed. Leverage hasn't disappeared. It's just been shifted. Risk hasn't been eliminated. It's been concentrated. Phase two. The aftershock. Weeks later, sometimes months, secondary stress emerges. Doesn't come from the same place. It doesn't look the same. But it hits the same pressure points. A bond auction fails. A bank quietly tightens lending. A fund gates withdrawals. A currency cracks. And suddenly volatility returns without warning. This is when markets realized the first crash was the event. It was the signal. Phase three, the divergence. This is where silver's role becomes critical. In prolonged instability, paper markets struggle. Trust erodes. Counterparty risk becomes visible. And assets begin to separate into two categories. Things that rely on confidence, things that rely on reality. Paper silver belongs to the first until delivery matters. Physical silver belongs to the second immediately. This is when spreads wide, premiums disconnect, and price stops being a single number. The screen shows one reality, physical market shows another. That divergence doesn't scream, it whispers, but it changes everything. Phase four, the policy response. Eventually, stress forces intervention. Central banks don't wait for collapse, they wait for threat. Liquidity facilities reopen. Rules quietly adjust. Balance sheets expand. Again. And when that happens, the dollar reverses. Not gradually, suddenly. That's when metals don't rise politely. They reprice, not because of optimism, but because the unit measuring them just weakened. The final truth. Crashes like this don't punish ignorance. They punish fragility. Too much leverage. Too much dependence on liquidity. Too much faith that markets will behave rationally. Silver didn't fail. It exposed stress upstream. And the people who come out stronger aren't the ones who predicted the crash. They're the ones who survived it intact. Because in the next phase of markets, the question won't be what will go up. It will be what can't be forced to sell. That distinction is about to matter more than any time in modern financial history. Every market shock redraws the map. Not everyone loses. Not everyone survives. The difference is intelligence. It's structure. Who loses? First. They always lose quietly at first, then all at once. One. Over-leveraged traders. Leverage turns volatility into a weapon. When prices move fast, math replaces opinion. Margin doesn't care if you're right. It only cares if you can pay. These players don't exit when they want to. They exit when they're told. Two, funds dependent on daily liquidity. If your strategy requires calm markets, tight spreads, and constant refinancing, this environment is hostile territory. Redemption force selling. Selling creates more stress. Stress invites more redemptions. It's a loop with only one ending. Three. Anyone confusing price value. Screens lie during crises. They don't show scarcity. They show urgency. Those who react every tick end up selling assets they should have owned at the exact moment the system needs them gone. Who survives? Survival isn't heroic. It's boring. One, leveraged holders, no margin, no forced liquidation, no deadlines. Time becomes an advantage instead of an enemy. Two, cash-rich operators. Liquidity is power in a liquidity crisis. When others are forced to sell, these players get to choose. They don't chase bottoms. They wait for sellers to finish, and they step in silently. Three, owners, not traders. Ownership changes psychology. If you don't need to sell today, tomorrow's price doesn't control you. You observe volatility instead of participating in it. Who actually wins? This is the part most people miss. The biggest winners aren't the bold. They're the patient. They understand one rule above all others. Markets don't transfer wealth from the smart to the stupid. They transfer from the fragile to the resilient. Silver, gold, cash, productive assets. None of these guarantee profit, but they reduce dependence on perfect timing. And in a system built on leverage, that alone is an edge. Why this moment matters. This wasn't a random crash. It was a stress test. And the system just told us something important. It is more leverage than advertised, more fragile than assumed, and far more sensitive to shocks than headlines admit. These events don't happen in isolation. They come in clusters. The first shock wakes people up. The second shock forces behavior to change. We're between those two right now. The question going forward. It's not, will silver go up or down? It's what happens if liquidity disappears again? Because if it does, the same assets will be sold first, the same mistakes will be repeated, and the same people will be surprised. Unless they're positioned differently this time. This is where narratives end and preparation begins. If you remember nothing else from this series, remember this. Most people misread the crisis entirely. They assume that what fell must keep falling. They panic. They sell. And that's exactly what the system expects them to do. The trap markets are psychological machines. They feed on unpredictable fear. Step one, the headline hits. Step two, prices drop violently. Step three, everyone looks at charts, panics and sells. What happens next? Liquidity evaporates. The fragile are wiped out. The resilient accumulate quietly. It's the oldest trick in finance. Make the smart appear dumb, the patient appear idle. Why this mistake will cost millions? People will chase momentum. They'll buy at the top tomorrow or sell at the bottom today. They forget the key rule. A crash is not the enemy. Panic is. Silver isn't the problem. Gold isn't the problem. Algorithms aren't the problem. Humans are. The real opportunity. The crash has revealed leverage. Who has cash? Who is unleveraged? Who holds the physical metal? These players now have a temporary monopoly on choice. Everyone else is forced to act against their own interest. If you're patient, you survive the margin calls. You avoid emotional selling. You collect the assets that were unfairly sold. If you panic, you get liquidated. You sell your best assets to pay for your worst bets. You're out of the game before the recovery even starts. How to position yourself. Correctly ignore the screen. Paper prices are manipulated by urgent sellers. Focus on scarcity and demand. Don't leverage. Volatility is amplified. Borrowed money is involved. Hold what matters. Physical assets, productive assets, or cash. Don't get caught chasing noise. Watch liquidity flows. Where cash moves, the rebound follows. The mindset. Shift. This is not fear. It's clarity. A liquidity crisis teaches you who is fragile and who is strong. It punishes the impatient and rewards the patient. Survival is your first victory. Profit comes next.